My name is Alex Perny. I'm a certified IRA services professional here at Advanta IRA. If you have any questions at all, please feel free to contact me directly. I'm always happy to kind of go through more specific situations, or if you'd actually like to do some breakdown of numbers insofar as I can do for you without offering tax or legal advice. I'm always happy to look at specific situations and see what kind of plan might work best for you, what might not, just all sorts of different stuff. Investment scenarios. I really enjoy this kind of stuff. So, there's no such thing as a stupid question when it comes to trying to save on your tax bill and strategies for especially the small business owner, the self-employed individual as to figuring that stuff out. So please use me as a resource, use Advanta as a resource. We are always happy to step in and try to help you out. A quick disclaimer before we do get too far into this: Advanta IRA and our employees do not provide investment or advice or endorse or promote any investment products. All informational materials are educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. Now, I know we had just a big chunk of people sign on, so keep in mind that all of your audio is muted on your end. If you have any questions, please type those into the chat box, and I will address those throughout the presentation. And please do, again, there's no such thing as a bad question. Sometimes it helps other people. Your specific scenario might help to enrich the call today. So please do make sure that you type those in if you do have any questions. So a few key takeaway points that I want people to take away from this. The biggest one really is the much larger contribution than IRAs, Roth and traditional specifically, that you have with employer-sponsored retirement plans. So SEP, simple, and solo 401k plans. And this will also translate into significantly higher amounts of deductions that you can potentially take for those. So the strategies regarding that, and then also how to administer the plans. There are some abilities for you as the self-employed individual or small business owners to take direct checkbook control of these plans. You don't necessarily have to, but again, you can certainly utilize these in many different fashions on how to do that. And then with regard to investment strategies, some of the biggest benefits of small business plans, namely the SEP or the solo 401k, is the ability to finance real estate purchases tax-free, and some of the other additional benefits that set a few of these plans apart from Roth and traditional, and even some other small business plans as well. So the larger deductions and contribution limits, the ability to administer these plans in a couple different directions, and the ability to use debt financing for real estate purchases is another really big thing that I want people to take away from here today. A little bit about Advanta IRA. We have almost 20 years of direct company experience in the industry. We have plenty of people here that have well over 10 years of industry experience as well. Anything that we administer as far as cash and assets go, if FDIC insurance extends, does cover anything that is held here with Advanta. And then right now we are need to update that, but we are very happy that we are closing in on almost $2 billion of assets under administration. I think it's sitting right around 1.8 at the moment, but that's something that we're very proud of here at Advantage, showing our continued growth and administration and custody of our clients' assets. And additionally to that, no matter what kind of account you have, so if you have a small business plan, if you just have an IRA with us, we always offer the same level of customer service. We offer dedicated account management to every single account that is here at Advanta. So if you have a $10,000 401k or solo 401k, or if you have $1 million Roth IRA, you always have a dedicated representative to call, ask any of your questions to, and get any of your matters taken care of in a very timely and efficient manner. So that's some of the things that we're proud of. Just want to let anyone know who's a little bit curious, maybe just coming in for the first time to one of our presentations today, exactly who we are and what kind of service we provide to our clients. So what is an employer-sponsored plan? It's important to understand kind of where we're starting from when we talk about these types of plans today, which again are going to be the solo 401k or self-directed 401k, SEP IRAs, and simple IRAs. These differentiate themselves from regular IRAs, and when I say regular IRA, I'm referring to either or Roth or traditional. So we're going to be kind of lumping stuff in for the remainder of the presentation. So it's important just to kind of know some of the nomenclature. If I refer to an employer-sponsored plan, unless I'm referring to a specific one, I'm going to be referring to all three of this 401k, SEP, and simple. And if I refer to a regular IRA, it is going to be a Roth or traditional. Now, these plans are initially kind of offered to businesses to help retain their employees and help them become more financially independent. But the nice thing is that even with these being legislated more towards medium, large, small businesses, it does trickle down into the self-employed individual or an individual that is working for an owner-operated business structure. So keep in mind that just because these may seem like you're talking about employees, these when we refer to employees, we're going to be referring to mainly the owner-operator of the business or you as the self-employed individual. So I like to spend a little bit of time just making sure that people understand some of the terminology in this, because if you're self-employed and you hear me talking about employee contribution portions, I don't want you to think that, oh, well, I missed the mark. I don't have employees. It's just me. You are an employee. You work for yourself. So when we talk about employee contributions to things, that's what we're referring to. And even if we're talking about something like net operating business income, that is still applicable to a self-employed individual, even if you do pass everything on, such as like if you are registered as a subchapter S corp, or you're treating an LLC as a pass-through. So keep in mind that these things can kind of work in a lot of different specific situations. And if you feel like something doesn't necessarily fall, you don't necessarily fall into the category of, give me a call. I'm always happy to kind of go through and more of the fine-tooth comb kind of review these kind of things. Just a little bit of history. The 401k did come out and was available to people going all the way back to 1975 after the 74 passing of the Employment Retirement Income Securities Act. So even though we're going to be talking about stuff here today that might seem a little bit exotic, people have been doing this for the better part of 40 to 50 years. So nothing here is kind of new or cutting edge. This stuff has been around for a long time. It's just a matter of fact that people aren't necessarily getting the education as to what some of their options are, especially when it comes to investment options for these types of plans. So I always like to just make sure people understand that even if you're kind of new to this, it's not necessarily something new in the marketplace. This stuff has been around and these options have been around for quite some time. So key parts of these types of plans. Now, again, we're focused on the self-employed individual or the small business owner today, but there's a few key components to understand when you're looking at one of these types of plans, because if you're not self-employed, and if there's anyone on the call today that isn't, and you think, oh, well, it'd be awesome if I could just put more money into a retirement plan and get those great tax benefits, you have to have some type of qualifying business activity to tie that plan to. So there's a couple different parts of this. You have the sponsoring business. And again, this can be you as a self-employed individual. It can be you as the sole member of an LLC or what have you. Is the sponsoring business what the plan is going to be attached to. So the entity that creates the plan for the benefit of its employees, and again, can be self-employed. This can be an LLC, can be a C Corp, sole proprietorship, it can be a limited partnership, it can be a whole myriad of different things. But a key point in this is there has to be some type of business activity or business entity that starts the plan. And then you have your participants or employees. Now, for a self-employed individual, you're mainly going to refer to yourself as a participant, but it can be interchanged with employee. If you're doing your own research, just understand that. So any eligible employee, business owner, spouse of business owners, and a few other people are what need to be included when you look at these plans. Now, looking at these plans with regards to eligibility for participation is very important, because although it may seem like, oh, this is fantastic, I can put all this money into this plan, there are labor laws that govern these to say, hey, if you do have, let's say, a rank and file employees, and I'll get to what exactly qualifies that a little bit later, you might have to include them when you're calculating your, let's say, a matching contribution for either a SEP, simple, or 401k. So sometimes these plans can get really expensive if you have employees. And under some plans, not all employees would qualify to be included. Namely, the simple plan would allow you to exclude a few more types of employees than either a SEP IRA or a solo 401k could. And those rules have changed a little bit in the past few years as well. Now, contributions can include voluntary funds contributed from each employee. So you might refer to that in more typical terms as a payroll deduction. So if you've ever been employed by someone that offered a 401k, it's your elective deferral. So that's a voluntary contribution from each employee, and that can change. That's not something that is involuntary or compulsory on the behalf of the business. Now, there are some types of plans that do have non-voluntary contributions, and meaning that if you do it for one person, you have to treat everyone equally, namely the solo 401k is like that. And the contributions, again, can include funds contributed by the employer, and different plans have different limits and formulas for those contributions, which we will also go through here as well. Okay, so 3 different types of plans specifically for the self-employed individual. And not all employer-sponsored plans are created equally. Some can greatly affect the way that you contribute cash and administer the plan, namely in the fact that some of these are one of these is trustee-driven, the solo 401k, meaning the business owner or the self-employed individual can directly administer the entire plan, write the checks, custody of the assets, do everything, and then the other 2 types, which are custodial-driven plans, the SEP and the simple IRA, are going to greatly differ in how the plans are administered and exactly how much control that you would have. So if your strategy is to maybe reduce overhead costs of establishing a plan, doing something like a solo 401k, you also have to factor in the cost-saving benefit of being able to do a lot more of the work yourself. But again, if that's not something you're interested in, having a custodial-driven plan where you employ a custodian, in this case Advanta, to take care of a lot more of the aspects of the plan might be of benefit to you, because if you're a self-employed individual or a business owner, you know that time is money, and depending on how much of that you have, there may or may not be a derivative cost savings to you for doing that. So just keep it in mind that the difference in plan administration can also affect cost as well. Now, different plans allow for corporate deductions, and some may allow for personal deductions as well. And this can also funnel down into how you file your taxes as well. If you are treating yourself as an employee of a corporation, one plan might inherently look a little bit better to you than another one. However, if you are passing everything through to yourself as let's say a sole proprietor or a Chapter S, then you might have a different benefit to be seen depending on how much money you're making as well. So things like the net operating income calculation for a solo 401k might be a really attractive option for someone that's just looking for the bigger total number to calculate their contribution for something like a solo 401k. And some of these plans require employee contributions to receive and employer contributions, and others do not. So some of these you can select. Let's say if you do have some employees, you can determine whether or not you would like to have everyone included in all parts of the contributions as well. So moving money to a self-directed account, just real quick, going to go through these 2 slides. You can transfer money from another custodian, which is non-taxable and non-reportable. It's just important to remember that if you have something like a traditional IRA and you want to move it directly to a SEP IRA, you can do that directly without any type of tax penalty or reporting. Now, if you're moving funds into something like a solo 401k, you do need to have that done as a direct rollover or an indirect rollover, which inherently is a reportable event, and you might be limited on how many of those types of movements you can do in a given year. So just keep that in mind. It's important to understand that the difference in plans is going to have a difference in your ability to move maybe multiple times per year. So plan contribution limits. Something to also keep in mind is that for the SEP IRA and the solo 401k, you have up until your extended filing deadline for your business return to make contributions to those plans and establish one if you didn't have one. So October 15th is when that extended filing deadline falls this year in 2020. I do not believe there should be any extension of that. I think the as far as tax filing deadline augmentation that we saw last year, I don't believe that we're going to have much of that, if any, this year. So we can probably pretty much bank on the deadline being October 15th to do this. So that means that if you'd like to establish one of these plans, and again, that is going to be a SEP IRA or a solo 401k, if you'd like to do that, you have up until October 15th to establish and contribute for last year. So you still have time in order to be able to do that and get some great tax deductions for the previous year. So just to go over real quick, not much has changed. The SEP IRA contribution went up $1,000 from 2020 to 2021. The 401k went up $1,000 in total from 2020 to 2021. So if you're looking to do a previous year contribution, your SEP IRA maximum would be $57,000 up to 25% of your total compensation. Simple IRAs, again, haven't changed. $13,500 of elective deferral, or an additional $3,000 if you're over 50, and up to 3% of an employer match on that plan. And then solo 401ks, they bumped up the amount of deferral that you can make out of the net operating income of the plan. So your elective deferral of compensation, so what you pay yourself, just what you can defer out of a paycheck, has remained the same at $19,500 with a $6,500 kicker if you're over 50. And then the 25% of the net operating income has gone up by $1,000, bringing your totals to either 58 or 64.5, just depending on how old you are. So, or which year you're trying to make the contributions for. So just real quick, those are the contribution changes. Again, nothing else has really changed materially on any of the other types of plans from 2020 to 2021, with the exception of those $1,000 bumps in both the SEP and the solo 401k. Now, employer plan options, again, the three that we're talking about here today are the simple IRA, the SEP IRA, and the individual 401k. Now, some types of options that you have. So when it comes time to looking at strategies, you can also absolutely need to look at the tax strategy benefit of your contributions that you're making, but also what you're looking to invest in. The great thing about, especially with solo 401k plans, is that if you self-administer it, you can have a diverse mixture of asset classes without increasing your administrative costs really at all, by being able to administer real estate assets right along more traditional securitized assets like stocks, bonds, and mutual funds, all within the same plan without having to have multiple different administrators and custodians. Now, if you are doing like a SEP or simple IRA, you would need to have that split out if you wanted to have security trading options available to that plan. But in general, if you're going to be doing it here at Advanta, most people are going to be namely interested in the more non-traditional and alternative assets, which is what we hold. We don't do any securities administration. So if it's a publicly traded security, it's not something we hold. But notes and mortgages, single member LLCs, futures, private placements, so startup companies, foreign exchange, and even things like oil and gas rights, tax liens, equipment leasing, structured settlements, all sorts of interesting things can be options to these plans. So if you're an individual that is looking for the ability to not be tied down to the stock market, all three of these plans are going to give you that option. And some would give you a little bit more diversity to do with the 401k, to do more of that directly under the plan without having to involve as many different people. So let's see. Okay. So here's some self-directed, and I should have changed the top of this slide, self-directed plan rules. There are some things that you cannot invest in and some big considerations to consider. Remember at the beginning of this, I said that there's strategies to utilize a solo 401k for avoiding having to pay taxes on debt finance real estate. So some things that you just can't inherently invest in with these plans are going to be life insurance, collectibles. Some coins are allowed if you're looking at investing in precious metals, but that's really mainly on the bullion content. You're not going to be trading them on the rarity or scarcity of the coin itself. So there are prohibited transactions. You cannot involve the plan with a disqualified person. The IRA or the 401k owner is considered a disqualified person from receiving a benefit of the assets of the plan. And if you'd like a little bit more detail on that, Internal Revenue Code 4975 does cover that in greater detail. Now, if you're going to be utilizing debt finance to buy a property, let's say you'd like to buy some real estate with one of these business plans, you are going to need to be aware that if you're using anything other than a solo 401k, you're going to have a UBIT / debt finance UDFI liability to be cognizant of. Now, you'd have to file a separate return for that. Now, a lot of people, especially if you're looking at doing alternative investing with a retirement plan, the last thing you want to do after you've created a bunch of awesome tax write-offs for yourself is engage in something that's going to create a new tax liability for a 401k, or sorry, for a retirement plan that you otherwise weren't expecting. So that's one thing that I really like to point out, is that a huge benefit in the strategy for utilizing 401ks is the exemption from that. So if you want to buy real estate and use financing to do it, a solo 401k is going to be far and away the most attractive option to do so. Now, the self-directed plan rules: who are the disqualified persons? The plan owner and their spouse, lineal descendants of the owner, grandparents, children, that kind of thing. If you look at this family tree right here, these are all the people you cannot directly invest with. And then also, one of the stranger things is that they do not disallow investments with siblings. So if you have a sibling, you can buy and sell and trade with them to your content. But just keep in mind that any of these individuals are going to be disqualified from directly engaging in business with the actual self-directed plan. So, qualified planner IRA. And here's where we kind of really break down into the strategy of which one might be the best option for you as the self-employed individual or as the small business owner, because these plans all have inherent benefits, but they also have some drawbacks. So with the 401k, there's no special discrimination testing for an owner-only business. So when you have larger safe harbor 401k plans, if you have rank and file employees, and I think in the next slide I cover exactly what that is, a 401k has to undergo plan discrimination testing, which essentially makes sure that any eligible, it's kind of its own standalone audit of the 401k plan and business to make sure that any eligible employee that is employed by the business is able to and participating in the plan. So that is an additional expense that you have to bear with 401ks. But if you are just an owner-operated business, if it's a self-employed individual or an owner-operated business, and that can be, let's say, an LLC that has 5 owner-operators, so everyone has an equitable stake in the business, you don't have to do that plan discrimination testing. But if you're a self-employed individual and you employ, let's say, a full-time bookkeeper, then you would need to include them in the plan. So it's not necessarily contingent on number of people covered by the plan, it's their qualification under eligible status according to the Department of Labor. Now, for 7 simple IRAs, you don't have that kind of plan testing and auditing, so it can be a significantly cheaper option to go with. But the downside of both of these plans is, one, that they would potentially be subject to UBIT if you are going to be utilizing debt financing to buy real estate, or if you are invested in like a limited partnership that has an underlying debt instrument for the purchase of, let's say, a larger multifamily complex. But the benefit to them is that you have a much cheaper initial administration cost. Simple plans can cover up to 100 employees, and SEP plans can have any number of employees. But when it comes to calculating how you're going to make contributions to those plans, you are going to have to extend the same treatment. So if you like to contribute on behalf of the business 25% of the individual's compensation to the plan, you would have to do that for every single person. So that could be significantly more expensive on the SEP IRA side of things. So just something to consider, that these plans, although you may see a better tax benefit on your initial analysis of using one versus the other, the administrative costs or the costs that you're going to see in the contributions that you are obligated to make to the plan for employees if you have them can be quite steep. And again, if anyone has any questions specific to this, or even if it's something a little bit farther out, make sure you type them in. I'm happy to address them as they come up. You don't necessarily need to wait for the end of this presentation to ask your questions. So, impact of other employees. what type of employees are excludable from an employer-based plan? Anyone that's under the age of 21, you can exclude from a plan. Non-resident aliens and certain unionized employees, if they're covered under collective bargaining, can automatically be excluded from any of these types of plans. So just because you maybe have an employee, if they are young, non-resident aliens, or unionized, you don't necessarily have to include them. Mainly for the people that are probably on this call, that doesn't necessarily apply, but it's important to remember and important part of this to look at with regard to that. Now, what types of employees must be included? So this has recently changed as of the Secure Act of 2018 or 2019. It was the large Trump tax cut included changes to the definition of employees for the purpose of coverage under retirement plans. So it used to just be anyone that worked 1,000 hours per year, but they also now added this for individuals that must be included. If you have someone that works for you at least 500 hours for 3 consecutive years over a 5-year testing period, then you have to include them as well. So it doesn't have to be someone that, you know, if they worked 600 hours a year for you for 3 consecutive years, you got to include them. So there's no more exclusion of that. Now, SEP IRAs, you have to include any of those people that have worked 3 of the last 5 years, so long as they meet the above criteria as well. And with simple IRAs, anyone that has received at least $5,000 in compensation during either of the last 2 years. So some advantages of the SEP and the simple IRA. They're definitely less expensive and easier to administer from the administrative standpoint. Personally, I do think that they tend to be a little bit pricier when it comes to contributions to the plans, because they are made up mainly of percentage-based non-elective contributions on behalf of the employer. Contributions are made to IRAs. There's no fiduciary liability on behalf of the employer. So you set it up and you are not responsible for the performance of the plan per se. The individuals get to select where and how they would like to administer the funds of that plan, which is a big benefit because you do get into fiduciary liability concerns when it comes to 401ks. The individual employees get to choose the IRA custodian. So if you have a SEP plan, most people will just do it all at the same place, but each employee, if they wanted to, let's say, be more invested in mutual funds, they could have a Vanguard account. If most of the people wanted to invest in real estate, the rest of the people could have a plan, could have their SEP IRAs here at Advanta IRA, and it wouldn't necessarily change the cost at all to the business. Now, that's a big deal because it lets you give a lot of flexibility to your employees with regard to how they actually invest those planned funds. Now, again, they're also portable from one custodian to another. Now, employer contributions only to the employees with more than 2 years of service for a simple IRA and 3 years of service for the SEP. You can change that if you want to include people that have worked for you for less time, but most people just go to the plan defaults in order to save money and retain longer tenured employees and just go with the maximal amounts. But you can change those down if you want to, if for some reason you did. Now, the solo 401k. And if it says 401k on here, just remember that all of these rules that we're kind of going over and the like are just, they all apply equally to larger 401k plans and the solo 401k plan. So you get all of the benefits of traditional business retirement plans like the SEP and the simple, plus you have higher funding limits. You can defer larger amounts of your earned income. So you have employee income and employer income. Now, if you are, again, treating yourself as a pass-through business, this might be a great opportunity for you to make kind of a double deduction with regard to what might otherwise be a business deduction. In another sense, you maybe get to pass it on to yourself personally. You have access to tax-free loans from the plan. So if you would like to access the funds of the plan early for whatever reason, you would like to get some of that out and not have to pay taxes and penalties, but you do want to pay it back, you can take a participant loan. So you can take out up to $50,000 or half of your vested plan balance as a personal loan and then repay that back over 5 years. Unfortunately, you can't just peg the interest rate on that loan at whatever you'd like to. It has to be a point above or below prime. And again, one of the biggest benefits is that you escape UBIT tax for leveraged real estate investments, especially for people that probably are on this call. The ability to finance property is something that a lot of people are aware of for IRAs, but don't elect to do it because you have to pay a tax on the revenues generated by that for an IRA. Again, SEP, simple, Roth, traditional, all of those have to pay a tax if you have leveraged real estate assets. 401ks have a huge benefit in that they're exempt from that. You also have can have pretty cost-effective administration for a solo 401k, and another big benefit is that you can also have a Roth 401k. SEP and simple IRAs are inherently always going to be pre-tax plans, so there is not a Roth SEP IRA or a Roth simple IRA. So another big benefit on the flexibility of the plan, especially if you're just trying to make sense of which one might be the best for your retirement strategy, is the fact that you can have pre-tax and post-tax contributions made to the same place underneath of the business plan utilizing a solo 401k. So let's look at some contribution comparisons, because just me rambling on about what this looks like and showing you numbers, it's probably a little bit easier if you know, we kind of put it up here. So John is a sole proprietor whose 20 salary is 100 grand. Because remember, you know, you can certainly make 2021 contributions, but you're probably, since it's before the tax filing deadline for your extended deadline of October 15th, you're going to be looking at what you made last year for quantifying these contributions. Now, I leave the simple IRA stuff up here, but if you didn't have that plan established before year's end of last year, you don't necessarily need to worry about it. But again, the SEP IRA and the solo 401k can still be established before your filing deadline to make contributions and have deductions for last year. So John's sole proprietor, 2020 made 100 grand. What's the right plan for John? So with a simple IRA, he can contribute $16,500 to the plan. He has $13,500 that he deferred out of his salary. Remember, that's the maximum you can defer, plus the $3,000 employer match. So $16,500 under the simple IRA is what you can potentially contribute if you paid yourself 100 grand. For a SEP IRA, it's going to be 25,000, because 100,000 times 0.25, easy enough. You can contribute 25% of your compensation to a SEP IRA, so that $25,000 is a straight line item tax deduction to John for that scenario. Now the solo 401k is pretty cool, because she can contribute potentially up to $44,500 of money to that plan. So he has $19,500 of salary deferral that he can just put in. So he gets straight out of what he's paid. Think about this like if you've worked for a larger company before, if you've participated in a 401k, this is what you would see just taken straight out of your paycheck on payroll, $19,500. And then the $25,000 employer match, that would be the profit sharing or whatever the company's matching for you. So he has $19,500 that he just drops in out of his personal pay, and then $25,000 of employer match, because he can contribute up to 25% of his net operating income, not to exceed $37,000 now. So 25%, again, of 100 grand is another 25. So he has $44,500 of the solo 401k. So just looking at that, $16,500 for a simple, $25,000 for a SEP IRA, and $44,000 for a solo 401k. Now, again, depending on what kind of deductions that you need or which type of plan makes the most sense with your employees is going to largely drive which one of those plans is the best choice. But it's good to kind of see the raw numbers. Now, let's say John's over 50. He would get a few bumps in that. So if he was over 50, his total simple IRA contribution would be $19,500. And if he was over 50, his total solo 401k contribution would be $51,000. Now, when it comes time to choose how you're going to administer these plans, how much control do you want? Again, self-employed individuals, time is money. You need to be very aware of how much effort you're putting into administering one of these plans, but there can be some pretty significant cost savings depending on what you're doing. So with a solo 401k, he has the ability to either utilize a third-party administrator, meaning Advanta, or he can do it himself as a DYO model. So do your own, take care of the whole plan yourself. Now keep in mind, this is different from SEP and simple IRAs in that you have to have a custodian. Because this is a trustee-driven plan, John has the ability to choose how he wants to take control and administer the assets and the cash of the plan. So the cash and the assets can be administered by Advanta as a third-party administrator or directly as John because he's the trustee of the plan. In both scenarios, the assets and investments are held in the name of the plan. So in this case, John Smith as trustee of the ABC 401k. So whether or not you use the model where we're acting as the third-party administrator or you're doing your own, the name of the ownership of the assets is always going to be the same. Think about what the title of the owner on a piece of real estate is, or the name of the lender on a note mortgage should be. That's exactly how it read as trustee of the plan. In either regard, John signs all documentation for either do your own or a third-party administrator-driven plan. Now, DYO plans have a trust account that you open up at a local bank that allows the individual, the trustee, in this case, John, to completely direct how those funds are administered without any use of a third-party administrator. But if John uses a third-party administrator to hold the funds, you'll need to request funds from the administrator to make investments, pay bills, etc. And keep in mind that all of the income from any investment is directed to the plan is non-taxable. So although if you are using deductible contributions and you understand that you have to pay taxes at a later date, any of the revenue generated by these investments are not taxable at the time of receipt. It's only later on down the road, if you have a tax deductible plan, that you have to pay taxes on those when you take distributions in retirement. Now, considerations of leverage. I've kind of hinted at it with regard to especially people looking to invest in real estate. Most of the time when people think about buying real estate, it is going to be from the aspect of saying, hey, I have X amount to put down and then I will finance the rest. Same holds true for people utilizing retirement plans. Now, there's a big downside to using IRAs, so SEP, simple, traditional Roth IRAs, and that you have a tax that you have to pay if you utilize that. Now, remember, with a 401k, you're exempt from that. Now, all employer plans can use leverage. Just because there's a better tax benefit to a 401k versus an IRA doesn't mean that a plan can't do it. But all financing must be non-recourse, meaning that the individual representative of the plan, so that either in an IRA, the individual account holder, the trustee, no one can offer a personal guarantee of the note. And in the event of default, the lender has to agree that the only recourse that they have is to foreclose the property or the underlying security to that note. So that is one big aspect of utilizing financing in these scenarios, is that it has to be non-recourse debt. Needing to understand UBIT and UDFI and how they're calculated is very important. That's kind of its own presentation in and of itself, which I'll actually be doing here next month. So if you would like, in 2 weeks, I'm going into a deep dive on calculating UBIT and UDFIT and how to calculate and how to avoid those as well. Different plans can use leverage with different considerations. That is the consideration between IRAs and 401ks. And again, no personal guarantee can be given in either of those scenarios. So just in a very basic context, when making a decision on which type of plan to use, especially if you're looking to invest in real estate and utilize financing, is that SEP and simple IRAs have this consideration. The amount of income derived from the leverage portion of the asset will be taxed, meaning that if you have a $200,000 property and you took a $100,000 note and it cash flows $2,000 a month in rent, then $1,000, so half of that income would be associated to the leverage portion of the property. It would be taxable under the UBIT standard. The tax assessed is tax assessed at trust rates, and you have to file 990T to pay those taxes. The plan has to file that. So whether that be a SEP, simple, traditional, Roth, the actual IRA has to file a tax return, not you personally. Now for 401ks, for acquisition debt of new property, a 401k is exempt from paying UDFIT. And if you operate a trade or business, however, then you potentially would have a UBIT liability. But if you're looking to acquire property just with utilizing debt financing under a 401k, definitely the more preferable account to be able to do that under. So that kind of concludes what I wanted to get out there to y'all today. Remember that with regard to selecting a retirement plan, you have up until October 15th to establish either a SEP or solo 401k and make contributions for last year. If you have questions on really kind of understanding the basis of deductibility for some of those, feel free to reach out to me directly. I can go over specifics with you in regard to specifically what it would look like for you as to which portions can and cannot be deductible, and making other decisions on things like utilizing Roth 401ks for traditional, calculating your liabilities with regard to having employees or multiple people covered under a SEP or another type of plan. So please do feel free to give me a call directly. I don't see that anyone has posed any questions. I'll stick around here for a little bit. If there's anyone that would like to ask a question or two, I am more than happy to answer them. So feel free to fire those out. But this is the end of the presentation. So if anyone has any questions, I will answer them. If not, we'll get this thing closed down and let you get back to your day here in a moment. All right, well, it looks like everyone is signing off. Thanks again for everyone for joining us today. And if you have any questions, please let me know.